Due to its low-cost exports of machinery, equipment, and consumer goods, China's economy has grown by more than 10% every year for decades. Because of this, China has the largest economy in the world. In 2020, it made up $23.01 trillion, or 18.3%, of the world's total GDP of $125.65 trillion GDP. China's economy is so big that if it slows down, it affects the whole world. In this video, we'll show you how China can crash the economy of the whole world. Before we start the countdown, please subscribe to our YouTube channel and click the bell icon. China's economy grew at a rate of 10.6% in 2010, but it will only grow at a rate of 2.3% in 2020. This is mostly because of the global COVID-19 pandemic. Even though China is slowing down a lot, it is still doing better than other developed economies. During that time, for example, the US economy grew by about 2% to 3%. Why China is slowing down? China's economy has slowed down because of two main things: a change made on purpose by Chinese leaders and the trade war between the US and China. Made in China 2025 plan. In 2015, the Chinese government put out a plan called Made in China 2025. It talked about how China's economy would change from being based on exports to focusing more on domestic consumption. China also wants to be a world leader in technology in areas like robotics, planes, and electric cars. Chinese companies were told they should invest abroad to learn more about technology. The plan also set goals for companies to make more parts in China and buy fewer parts from other countries. To help, other countries are especially worried that the Chinese government might make it impossible for foreign companies to take part in its economy. US launches trade war. In 2018, China and the United States started a trade war. The US raised tariffs on Chinese goods worth $250 billion. In response, China put tariffs on $110 billion worth of US goods. Trade between the two countries dropped from $635 billion in 2017 to $558 billion in 2019 because of the trade war. The American Chamber of Commerce in China, AmCham, polled businesses and found that more than one-fifth of them saw a drop in sales in 2019. Nearly 25% of businesses cut back on spending. But the Phase 1 trade deal, which was signed at the end of 2019, was meant to cut tariffs on both sides. China agreed to buy more goods from the United States. These steps should make it easier for the two superpowers to trade with each other. Implications for the US economy. China and the US share a lot of economic benefits with each other. The US will be affected by a slowdown in China in three main ways: trade, the US debt, and the value of the US dollar. US-China trade. China and the US trade with each other more than any other two countries. In 2020, the United States sent $124 billion worth of goods to China. If China's economy slows down, it will also slow down its demand for US exports like commercial planes, cars, and food. In 2020, the United States bought $434.7 billion worth of goods from China. Most of these were computers, cell phones, clothes, and toys. The difference between how much the US sells to China and how much it buys from China is $310 billion. Because of this, the US trade deficit with China is the largest. Many imports from China come from the US, where factories send raw materials to be put together at a lower cost. When they are sent back to the United States, they are called imports. Because of this, the trade deficit helps a lot of American businesses in a roundabout way. Impact on US treasuries. China's slowing growth could also make it harder for the US to borrow more money. China has the second most US treasuries of any country. As China's exports to the US go down, its government has less money to buy US government bonds. The Chinese government gets these dollars from Chinese companies that get them as payment for exports. It is thought that China has accepted slower growth with this new plan. If there is less demand, the US Treasury will have to offer higher interest rates when it puts the notes up for auction. This causes US interest rates to go up because banks set mortgage rates based on the 10-year Treasury yield. Higher interest rates could also stop Congress from spending more money on the government. That would then slow the growth of the US economy. Value of the US dollar. As China buys less US Treasury bonds, demand for the dollar will go down as well. Treasuries are one way to figure out how much a dollar is worth. Because of this, the dollar could lose value against the yuan. As the dollar gets weaker, imports will cost more at the store. This is true especially for oil and gas. The price of these contracts is given in dollars. If the dollar falls, oil exporting countries could cut production to raise prices and make up for the drop in the dollar. At the same time, a weak dollar would help US exporters because it would make their products cheaper in other countries. The high level of economic integration between China and the United States puts the average American at risk. Even though the higher tariffs have been put in place as part of the trade war between the US and China, Americans continue to buy goods from China at a record rate. With US inflation going up and China still being a key part of US companies' supply chains, Beijing's pandemic policies will cause Chinese factories to slow down, which will push up prices in the US, hurting consumers and businesses that are already struggling to deal with the return of inflation. Also, the US economy shrank in the first quarter of 2022, and economists are more and more sure that the US will go into a recession in the next year or so, even if China doesn't implode. China is also a big foreign market for goods and services made in the United States. Only Canada and Mexico are bigger. A slowing Chinese economy means less demand for US products like cars, electrical machinery, medical equipment, and fuel. This hurts American businesses and workers who depend on exporting to China. Lastly, the Chinese Communist Party gets a lot of its legitimacy from keeping the economy growing and the country's standard of living going up. If a big drop in the economy threatens to make the party less likely to stay in power, this could lead to a more aggressive, nationalist foreign policy. There's nothing like a little patriotism in war to make people forget about problems at home. Yes, a China with a weaker economy would have to choose between spending money on the military and spending money on other goals. But there's no guarantee that Beijing wouldn't get even more aggressive abroad and loosen up elsewhere. With a big land war going on in Europe, the US economy slowing down, and China's problems becoming more obvious, the chance of a global recession is growing. To be clear, Beijing's economic policies pose big problems that need to be fixed, whether it's unfair competition with market-based economies in the West or China's systematic attacks on the rules-based trading system. But if you want China to play a more positive role in the world economy, you have to deal with these problems head-on. You can't force China to do this by hoping that its economy will fail. A big drop in China could hurt the rest of the world in ways that no one could have predicted. So that's it for today. If you think this video is helpful, please leave a comment and share it with your friends. Press the bell button and subscribe to our YouTube channel to see all the latest videos. Thanks for watching.